Hey everybody, Economic Ninja here. I found a story in the Hedge. I'm going to link it below. I'm going to go over it because I think it's very important. On the heels of what we saw the other day, just massive downturn in the markets. We saw, somewhere around 4% at the low, only to by the end of the day close green. Absolutely unbelievable. Tons of money came in and bought the dip. We are going from, just touching correction territory to even in some markets like what I believe the Russell 2000 hitting bear market territory to watch people come in and buy the dip. And I think people are so confused. And this is a very, very good article. And I want to talk to you about it, okay? It says, after yesterday's head fake, Stifel says, wait for these 5 signs to buy the dip. All right. Now, just so you guys know, full disclosure, this is not financial advice. I'm not a financial professional. However, I am moving right now money into my different brokerage accounts for both cryptocurrency and stocks, getting ready for what I believe could be something coming. All right. I think that we're going to see some more pain. We're still waiting on the Federal Reserve's meeting. It's going to be a big deal because people are hoping for them to come out a little bit more dovish. Okay. So here we go. So this is what everybody wants to know, when to buy the dip. Now you can see I've already passed up a lot, so if you guys want to read the article, please do. It says Stifel's Barry Bannister warned in a note this morning that yesterday was a head fake and says there are 5 signs we need to see for a probably late Q1 of 2022 major index low to occur and the correction to end. All right, now I believe the same thing, but there's some reasons behind that. So we're going to go into his reasons and I'm going to tell you mine, okay? First off, the Fed would have to turn more dovish. Because such a dovish turn would likely lower the 10-year TIPS real yield, which has been pressuring growth stock PE ratios much more than for value. Fading inflation with a sticky nominal 10-year Treasury yield is our expectation for the peak of the 10-year TIPS yield, which we do not believe is occurred. Okay, I'm just going to break this down really simply. The second the Fed turns more dovish, I believe you're going to see markets turn up, right? But for right now, there is pressure and a tantrum being thrown because most investors understand that there's no way you can pull off raising rates, and it is only going to hurt the economy even more because of the sheer amount of debt and where we are as an economy right now, okay? So when we see the Fed turn more dovish, that's when we're going to see stuff start to rise, right? But not right away. Number 2, the U.S. PMI manufacturing index would have to bottom, which we doubt occurs before the end of Q1 of 2022 with the, let me explain this really lightly. Okay, the U.S. PMI manufacturing index would have to bottom. One thing is for sure, we are sort of in an illusion right now because the economy was stopped and then fired back up again. We are seeing a lot of things in catch-up mode, especially with all these shortages like chips, things like that, okay? So it's really hard to judge the health of economy when you're looking at certain indexes, one being the manufacturing index. I've talked about how construction is a lagging indicator to show the health of real estate market because of how long it takes to get new projects on. The manufacturing index is the same. It tells you the history, not the future, okay? So we'd have to see that bottom. Number 3, global M2 money supply growth would have to decisively bottom and the dollar top. He says, which is unlikely to occur until China's currency weakens. We're talking about the CNY. We believe the next shoe to drop is China's currency slipping from a strong 6.33 per $1 to around 6.75 per $1. All right. China is 37% of the global money supply. So yes, as China's currency has been strengthening, we've been seeing issues, and if it was to fall, that would tell a lot of what's going on in the global economy, okay? Number 4, S&P 500 quarterly earnings per share beats minus misses will have to bottom. So it says, but the beats minus misses difference has faded since the end of a stellar string for earnings per share through the first half of 2021. When EPS beats minus misses are under pressure, in the case of falling below the long-term trend, investors in the S&P 500 must learn to live with diminished policy support. So we're already seeing that where the stock markets are being held up by a certain amount of big stocks, and a lot of indexes are showing the truth is that by and large a majority of stocks are already down on the year, and I mean I'm referring to 2021, And it's just a point where investors start to really realize what has been driving this growth. Now, number 5, Ukraine will have to be settled in a way that does not diminish U.S. living standards. It says, but that is far from certain in many ways. It appears to us that Russian President Putin is playing chess while the West is playing checkers, such as NATO moving troops to Eastern Europe while leaving Ukraine exposed. All right, so first off, again, there's the whole Ukraine story. There is so many things that are not solved. Is this saber rattling? Is it going to turn into something more? That's the problem. The markets don't know, so they don't know how to invest. And that's why there's certain investors moving into safety and security because they believe that a war is imminent and that could cause catastrophic failures in markets or loss of confidence. And it's such a key point in the world. It would disrupt a lot of things, everything from shipping and manufacturing to, like I was saying, or like they're saying, our way of life. Okay. So this could cause all kinds of things like energy to spike. There's all kinds of issues. So I thought I would bring these up because I believe personally, like I said, I'm moving money into markets. I'm keeping it in cash. Remember, I've been talking about this for about 4 months now. I'm moving into a cash position. I meant I didn't sell any of my cryptocurrencies, current stocks, or any of my other holdings. I was accumulating cash. So instead of putting money into those sectors, I started to accumulate cash. Why? For what I've been talking about is a liquidation event or a deleveraging of debt. A lot of people can call this disinflation or deflation because I am looking to buy some deals. I do believe that eventually there's going to be enough pain in the markets where the Ford is forced to show its hand because it never intends to raise rates, in my opinion. And that's just an opinion. But I believe that you are going to see them back off and say, not only we're going to stop, we're not going to raise rates. If that doesn't do it, they're going to have to actually lower rates. And I know that sounds crazy, but I've talked about that as well, negative rates. All right, guys, that being said, I hope you got something out of this. The Economic Ninja is out.